So we just had the third consecutive quarter of losses in both stocks and bonds. So let's unpack that a bit. For stocks, we're still in a bear market. U.S. stocks were down almost 5%. There were no major divergences within different categories. So large companies and small companies had similar returns. Faster growing companies were down a similar amount compared to cheaper companies. And overall, the losses were pretty modest. But because of the path that returns took, it probably feels a lot worse than the numbers might suggest. So earlier in the summer, we had a nice double-digit rally, and things were looking a lot better. But since then, we've had another sell-off. Stocks are down at new lows now, and we're very much still in a bear market. And the primary driver of returns continues to be inflation and the Federal Reserve's response to inflation. So a few weeks ago at one of their meetings, the Fed was very clear in communicating that bringing down inflation is their top priority, and they're going to do whatever it takes to accomplish that, even if it means unemployment rising or sending us into a recession. And so the market responded accordingly. On the international side, it was also a challenging quarter, and a big part of that was currency. So the US dollar has been very strong this year, and what that means is it's a good time to travel overseas. Your money's going to go a lot farther, but from an investment standpoint, that serves as a headwind for US investors. And so between that and, of course, a lot of geopolitical unrest, it was a challenging quarter on the international side as well. Moving on to bonds, bonds were down yet again, extending losses in what continues to be the worst year for bonds in history. Interest rates rose above investor expectations, so you can see the long government bonds got hit the hardest, but credit markets were actually okay. Credit held up fairly well. You can see high yield bonds were just barely down for the quarter. And we'll get into a lot more detail with the bond market later, but for now, with all these red numbers, I thought I'd leave you with two reminders. So one is that bear markets are inevitable. In order to get a return, you have to be willing to accept risk. And so we get that risk premium because of markets like this and downturns like this. And so this is just part of investing. It's the dues that investors have to pay for those long-term returns. And then second, bear markets create opportunity. So stocks are a lot cheaper than they've been for a while now, and there's some really attractive areas within the stock market. Also, bonds and cash are paying a lot more in interest than they have in quite some time. So that sets us up well for returns moving forward. So even though it's been a challenging year, there's definitely still some reasons for optimism in the markets.